Hello everyone, my name is MiaoFei. I study computational finance in University of Essex. My dissertation topic is trading pattern searching with cluster analysis and genetic programming. This project is a cooperative research project with the Old Mutual Asset Management Company of the UK. The Old Mutual is a global long-term saving and investment product provider. This research is a portfolio optimization problem with several distinct indicator factors. The research bases on the data provided by Old Mutual. Basically, the data is monthly return rates over 213 months of the 1,550 companies which used to be listed or are listed right now in the London Stock Exchange. In addition, 4 indicators tables which are the same size as the return table are given. Consequently, each return rate in return tables has 4 indicators which are associated with it. So basically, the monthly return given is of 1,550 rows times 213 columns. The indicators are the price-book ratio, the price-earning ratio, the momentum, and the accruals, respectively. The price-book ratio measures how cheap or expensive a stock is. The price-earning ratio is the price to its forecasted earning in 2 years. So they are valuation ratio from analysis. The price momentum is based on 12-month price. This ratio based on the idea that stocks which have gone up in price trend are likely to continue going up. The aim of the project. The aim of this project is to compete the benchmark portfolio given, which is showing here. In the benchmark performance, there are 5 cumulative return lines. 4 of them are generated by 4 indicators. The portfolio line, which is the purple one, is generated by linearly summing up all other 4 indicators. The benchmark trading rules based on the values of each indicator. The values of indicators are 1, 2, and 3. 1 means the price look downward, so to sell. 3 means the price look upward, therefore to buy. 2 means neutral outlook, the reaction is do nothing. We can see from the plot that the purple line goes along the up border of the plot. This means it performed very well. Our aim of research is to generate another portfolio line which is even higher than this one. The methodology. In this study, we use 2 techniques to achieve the aim of portfolio optimization. The first technique is the cluster analysis. The other one is the genetic programming. Let's have a look at cluster analysis first. The cluster analysis. Clustering is the task of assigning a set of objects into groups so that the objects in the same cluster are more similar to each other than to those in other clusters. Here, we show different ways of clustering the same set of points. We can see the original point in the subplot A. With different classification criterions, we can group those points into 2, 4, or 6 clusters, just as shown in the subplot B, C, and D, respectively. There are various techniques to do classification. For example, the most common method is to agglomerative hierarchy clustering. This approach refers to a collection of clustering techniques that produce a hierarchy clustering by starting with each point as a singleton cluster, and then repeatedly merging the two closest clusters onto a single or encompassing cluster remains. In cluster measures, in cluster analysis, the terms of a distance is the pairwise distance between pairs of objects. The distance between objects are measured by their similarity, which are a series of rules differ cluster from each other. The terms of linkage in cluster analysis is a criterion to measure similarity between different clusters. The most common linkage are single linkage, complete linkage, and the group average linkage, etc. Take the simple linkage as example. It uses the smallest distance between objects in the two clusters to differ two clusters. In this study, our distance function is derived from the correlation coefficient of a company's returns. Alright, now the cluster analysis is used as a filter. The original data is firstly passed into cluster analysis. The cluster algorithm trim, agglomerative, and classify the companies into different groups, and then the filtered data is used to evaluate the training strategy, which are generated by the genetic programming. The training strategy is scored by how well they compete the benchmark performance. After generations and generations of evolving, the best strategy will be found. Now, let's introduce the genetic programming. Genetic programming is an evolutionary algorithm-based methodology inspired by biology evolution to find computer programs that perform a user-defined task. It's a specialization of a genetic algorithm where each individual is a computer program. In order to accommodate the project information into GP, the original data is converted into a single table shown here. Consequently, the optimization problem is converted into a symbolic function y equal fxt. The x is the indicators. The t is the target function. Here t is the function of a portfolio return. The function means if return of a portfolio is above 20%, it will return 1. If the portfolio loss is more than 20%, then it will return -1. Otherwise, return 0. In this table, the first 4 columns represent indicators, and the last column represents the target. Each row is one stock in 1 month. Each 1,550 rows represent all stocks in market for 1 month. Actually, after filtered by clustering, less companies in each month are passed into the GP. With the GP, we develop a trading rule which reproduces the buying rule in the benchmark. The rule showing here represents if the indicator PB is 3, then buy, or if the indicator PE is 3, then buy, or if the indicator price momentum is 3, then buy, or if the indicator of accruals is 3, then buy. Apart from the buying rules above, GP can evolve the selling rules and all exactly the same rules that are used in the benchmark portfolio. This suggested that we can reproduce the same trading rules as the one in the benchmark portfolio. Actually, this trading strategy shown here is only one out of the numerous of rules which GP can create. Each strategy is evaluated by trading stocks, which are trimmed by the pre-clustering procedure. The next few slides will show our results of experiments. The first page shows here the result of clustering. We divided available companies in each month into 2 classes with 7 different linkage methods. In each subplot, the x-axis is the index of a month. The y-axis is the numbers of available companies. The blue area represents the numbers of companies of the cluster 1, while the red area represents the number of companies of cluster the type 2. For example, in the first plot, which is the single linkage, during around the 5th month, there are 2 or 3 blue lines. This means companies of the cluster type 1 dominates these 2 months or 3. However, companies of cluster type 2 dominate the rest of the whole experiment period. This slide shows portfolio performance derived from different clustering methods with different models. The model 1 means we only choose companies which are members of the cluster type 1. Likewise, the model 2, we only choose companies which are the cluster type 2. The model 3 is that we only choose companies from the cluster, the member of which dominate the month. In this page, all 3 subplots of line charts show the performance from 7 different linkage methods. The x-axis represents the index of experiments, while the y-axis represents the average monthly net return of the portfolio. In the subplot of model 1, which is as the up right corner, we notice that the performance with the complete linkage, which is a red line with a square, is the best one. At the 7th experiment, the portfolio return reached about 0.8 per month. This is the strategy generated by GP, produce the best portfolio return with the complete linkage clustering we show in the last slides. This page shows the comparison of performance of different methods used in this study. The x-axis represents the time, while the y-axis represents the cumulative return of portfolios. The blue line is the benchmark performance. The red line is derived by the strategy generated by normal genetic programming without clustering. The green line is the best performance from the strategy generated by GP with the complete linkage clustering. We can see from the plot, GP with clustering is better than GP without clustering and far more better than the benchmark performance. Conclusion. Our study here shows that the GP is a powerful tool to looking for meaningful patterns from the historical data, while the cluster analysis study the data without a priori knowledge. Combining these 2 approaches can produce even more promising results in financial forecasting. Thank you for your watching. Goodbye.